Hey, y'all. Welcome to another episode of the Texas Blockcast. Today, I'm sitting down with Matt Williams, the head of derivatives at Luxor, a longtime member of the TVC and a great US-based mining pool. Matt, thanks for coming on.
Oh, thank you for having me, Lee. Appreciate it.
Well, we're going to get into some complex topics in finance today. And I've heard you on other podcasts before talk a little bit about your background. I think it's important for people to understand a little bit about your CME background and sort of your commodities and derivatives background. So can you just give us a piece of that before we dive in?
Yeah, of course. So I like to joke. I've been in the derivatives world pretty much my whole life, and like not just my career. My both my grandfathers were traders at the Chicago Board of Trade. My dad was a trader, uncles, cousins, like you name it. I've been in it for a very long time. I did start off my trading career in New York on the NYMEX. Used to trade WTI and Henry Hub to start my career. Transition from energies into agriculture products, so corn, wheat, soybeans. Did that in Chicago for a number of years as well, and then made my way over to the Chicago Mercantile Exchange, as you mentioned. I started off at the CME on the corporate strategy side of things and kind of quickly, this was like 2015, 2016. At the time, there was a heavy focus on the digital asset space. So they put together a digital asset team that I contributed to, ultimately led to me being a part of the team that launched Bitcoin futures. And that's like towards the end of 2017. Also spent the latter couple of years there on they had a venture capital arm that invested in digital assets as well. And then after leaving CME, I spent 2 years at a regulator. So I kind of split time between the National Futures Association and then worked with the lab CFTC, which was their innovation arm.
Hmm.
And then actually tomorrow will be my 2 year anniversary at Luxor.
And since you've been, I think they poached you specifically for this derivative stuff, right? Hash rate derivatives and non-deliverable forwards and all that stuff. So let's break down Luxor's products in this space.
Yeah, so when I joined, we didn't really have a product specifically in mind, like the structure that we wanted to build. Credit goes to Ethan, Nick, and Guzman and Eddie for having the vision to kind of develop hash rate derivatives. And, like I think they knew that there was a gap in the space where, miners had the ability, through energy derivatives to hedge their energy exposure and Bitcoin derivatives to hedge their treasury exposure. Not to say that all of them were doing it, but the tools existed. However, on the revenue side of things, the actual revenue that you can expect from your hash rate, there was a gap there. Not just, and even beyond Luxor, there was this call for hash rate derivatives. So when I was hired, they explained to me the gap, and the goal was to leverage my background in commodities world to kind of come up with the right structure that would be appropriate to fill that gap. And so, we had 6 months of kind of like going out, talking to miners, talking to the community, and trying to understand like what their needs were, and then just went to work on building the product. So, it's not, I don't think I'm like this, it's super genius out there. We basically just took derivatives that existed in the commodity world already. Like these are prevalent in agriculture and energy products too. So basically, we're like, all right, let's use this format, meaning like forwards, and futures, and we'll build a product suite. And so that's what we did. And so to your point, we started with two flagship products. The first one was what's called a non-deliverable forward, or an NDF. The NDF essentially revolves around the index that we run. So I know you're aware, but for the listeners that aren't aware, we run an index called the hash rate index. And on that index, it tracks the expected value of one petahash of hash rate on a daily basis. And that could be either in Bitcoin terms, like how much Bitcoin you can expect to earn, or dollar denomination as well. And so basically this index, and you can think of it kind of like the S&P 500 index or Bitcoin indexes. You have this central underlying asset, which is the index, and then you build derivatives around it. And that's exactly what we did. And it's basically the same thing we did at CME, where you build the index first and then the derivatives around it second. And so that's the crux of our flagship product and honestly everything we've built since. And so, happy to go whatever direction you want in terms of, deeper dive.
Let's imagine that I am a miner and you are a fund that wants exposure to Bitcoin, Bitcoin mining in particular. And I've got 1 exahash of mining, or let's make it easy. Well, that is easy math. Well, I have 1 exahash of mining, and I want to hedge half of it, 50% of it.
Okay.
Um, and you're purchasing the other side of that contract. Walk us through how that would look.
Yeah, so there's just taking a quick step back. There's two different products we have. So one is the one I originally described, which is index based. So that one is settled in either USD or BTC. There's another one which is a physical forward. So in the physical forward, a miner can literally sell their forward production and the buyer will buy that production at a discount. And the trade-off is the miner gets Bitcoin up front relative to the advance that they're trying to sell, and then the buyer gets discounted hash rate. So those are the two flavors. But going to your example, so a miner wants to hedge 500 petahash, right? They can do one of two things. They could use that the cash settle instrument, and basically what they're doing is they're locking in hash price for let's say 6 months. So based on where the market dynamics are, where the bids and the offers are, they can come in and say, well, let's just use today's prices. So it's right below $50 a petahash. So they say, all right, I'm going to lock it in at $50 a petahash for the next 6 months. And that now they know exactly what they can expect to earn from that amount of hash rate. And so that's, it's like any other product hedge where you're saying, all right, I'm locking in a fixed amount. And if prices go lower, you make up for it on the hedge. And if they go higher, well, you're mining more profitably, but you lose on the hedge. So effectively, you're just locking it in. I think a lot of people kind of get in the head, people new to hedging get confused that hedging should be like a additional revenue source, but it's not. It's just revenue certainty. You're just locking in price.
Yeah, that makes sense. What are the current what's the current discount that you would estimate that a petahash is trading for? Is it like a 2% discount to what they would otherwise make?
So it's actually very interesting times post halving. So our forward curve, historically speaking, has been in backwardation, meaning like it's a discount to spot. But now it's in contango. So you're seeing prices that are higher than spot prices or higher than the expected value. So right now it's not a discount anymore. It's parity or a little bit higher.
Really?
And that a lot of that has to do with transaction fees and the spike that we've seen there. Plus, we're about to see a pretty sizable drop in network hash rate as well.
Just because people are going to get smoked by the increasing difficulty right now in the halving?
Yeah, you got summer coming up too, like in Texas how that is as well. So
Yeah.
yeah, combination of the two.
Yeah.
We're definitely like kind of flirting with that unprofitable level in terms of hash price, for certain miners that don't have great power contracts.
Okay, so explain Contango for the audience. I've heard Jamie McAvity talk about this, but
Yeah, so I mean, essentially, like most forward curves trade in contango, meaning like the expected value of an asset or a commodity is going to be higher than it is now. And so like Bitcoin's a prime example. But if you look at the Bitcoin futures and the forward curve there, it's trading higher than it is now. Now that can be way higher, it can be just a little bit higher depending on the economic environment. However, it's the opposite in hash price, and that's because of what we see a very steady growth in network hash rate, right? And so as network hash rate goes up, it's difficulty increases and it becomes harder to mine. And so you'll see and then combine that with the halving schedule and historically flat transaction fees. The hash price has been in a downward spiral, basically since inception. And so, but what we're seeing now with the spike in transaction fees and a lot of volatility there, it's flipped. So now the expectation is that hash price is going to be higher in the future than it is now. And that's what contango means.
So let's break that down a little bit. I mean, so we're expecting a decrease in difficulty because of hash rate going offline because of the summer and just some unprofitable miners unplugging because of the halving and or poor power contracts or probably both, right?
Yeah.
And then where the market is telling us this forward market is telling us that the market expects increased transaction fees in the future. I wonder why that would be though, because the runes transaction fees spiked pretty strong for 48 hours, but plummeted after that. So are there other, applications that people are looking to in addition to runes and ordinals?
It's actually a combination of things, and I'll add one more thing to that as well. So I'll address the first question or the last question first. So yes, like we saw a massive spike at the halving with runes, and even before that with other ordinal projects. I think the prevailing thought is that there'll be more and more of these projects. Now, when they happen and when they're released and what the impact that has on transaction fees is anyone's guess, but the volatility will definitely be there. And so the market makers or the participants that are on the platform, rightfully so, are scared of that volatility. And so they'd rather be on the longer side than the shorter side because it's easier to get run over on a short with an unexpected spike in transaction fees. So that's kind of reflected there. And then also, like, as you're getting closer to unprofitability for the miners at these levels, you have what's called, kind of like a hypothetical floor, and we're close. So, we're at all-time lows. And so, the thought being like it'd be very hard for it to go lower because more hash rate will come online. And we're already seeing that right now. Like we're
Yeah.
95% of the way through the epoch, and it's looking like a 6% adjustment, negative adjustment. And so, that's kind of testing the floor. So naturally, people are going to be more inclined to buy because they feel like there's a bounce coming.
Yeah. So what kind of time period are you guys working with on these forwards? Like I feel like the last time I heard about it, it was 3 months. Is that accurate?
We're now at 6 months. And so both forward contracts go out 6 months. Very shortly, we'll be working to go out to 12 months. And then just as of a couple of days ago, we got CFTC approval for our futures contract too. So we'll be listing a exchange listed futures contract on a exchange called Binomial. And the goal with that is to go out 12 months, maybe even 18 months, and try and align it more with like power contracts or energy contracts.
What's the sort of, um, I guess, imbalance of bids and asks, if you will, or buyers and sellers of this? Uh, I've got to imagine that there's more sellers than buyers at the moment. Is that accurate?
It's actually the inverse of what you said.
Really?
Yeah, when we first launched, it was all sellers, right? Because we were just pitching this to miners as a hedging tool, and if you just have hedgers, it's all sell side pressure.
Yeah.
And so we combated that by just going out and talking to as many different participants outside of the mining world. It's like crypto native hedge funds, family offices, private equity. And then, that it didn't completely equalize the balance, but it got much better. And then we onboarded market makers. And so we were able to provide a great amount of liquidity for the miners. But now what we're seeing is, well, it's kind of weird. So kind of what I was talking about before, as you see in Contango, people are really interested in this product now because it's the only exposure you can get to transaction fees outside of being a miner. So like
Ah,
if you want to speculate or get exposure to the long side, this is the product. And then we've seen a huge influx of miners on the buy side as well,
really?
which yeah, so like either they're trying to get synthetic hash rate or more exposure in a short term. But miners are on both sides of this for sure.
That's fascinating.
Yeah. So right now, and this changes to be honest, like month to month, the answer to your question might change, but right now it's I wouldn't say heavily weighted on the buy side, but there's definitely more buyers than sellers.
I've thought about this with like when we're talking about financing these very expensive infrastructure deals, um, in certain other commodities industries, everything is hedged. And so like the bank has very little risk,
Yep.
or the lender, if you will. And I'm thinking about like, equipment financing, infrastructure, like ASICs, transformers, whatever is the collateral, or unsecured. If there's a hedge both on the power side and on the hash price side, if you will, um, it seems like it would be a much more attractive financing um, opportunity.
Yeah, I've said this exact same thing for a very long time, and I totally agree with you. I think what I was missing when I was saying that is at least the public miners were, there's such a high beta to Bitcoin that they're incentivized to get as much Bitcoin on the balance sheet and not hedge it. And that's that's how their share price was rewarded, is like more Bitcoin, more ASICs, more growth. But now that shifted, right? Since the ETF launched, they're not the beta play to Bitcoin anymore. With the halving, their margins have shrunk considerably. So now, to your point, like if you want to act like um, more like an oil producer, you have to start hedging more. And that's all your exposures, right? Like your revenue, your energy, your treasury, in order to get better financing terms. And I think that's going to be the shift that we see going forward.
Do you find it that it's more attractive for a private miner to pursue debt financing and therefore hedging versus a public miner because they have that at the market offering that they can tap?
I would say we definitely had more success earlier with the private miners because it was easier for them to get onboarded. Not
Okay.
because, not, but since the beginning of this year, we've onboarded almost, I would say 75% of the major public miners are onboarded to our platform now. And some of those
But
just took a very long time to onboard.
do
Sorry,
y'all have any competitors?
there's been people that have tried. And to be honest, I say this almost every time I get asked this question. We would welcome more markets. I think it'd
Yeah.
be better for the space. I think it'd be better for us in terms of liquidity. So, we've seen other people come. We've engaged with competitors to help them in any way we can. So, I mean, the real answer is no. There's nothing right now outside of what
Yeah.
we're offering.
Yeah.
There's some talk of some other people doing things, but I wouldn't say anything's got liquidity or.
Just from like like a revenue perspective for Luxor, I would imagine, and correct me if I'm wrong, the mining pool revenue is probably pretty abysmal. And just as it is, not in particular for Luxor, that's just in general for pools writ large. They have other revenue streams that actually finance the pool portion of, and I know that's definitely true for Foundry based upon their fees, is essentially zero fees, if that's still the case. When I was looking at it a while ago, that's what it was. So this could be a pretty significant development for Luxor from a revenue perspective. Um, is that accurate, or am I thinking about that incorrectly?
I think largely you're thinking about it correctly. I wouldn't say the mining pool at Luxor at least is a loss leader. It's still profitable, and as Bitcoin does well, so do we. But it's not the main area of focus. It's more like the glue for us.
The
Like,
glue, yeah. You create sticky customers that way.
yeah, well, and it enables other businesses, mine in particular. So our physical forward. So if we bring a miner in and they want to sell 500 petahash forward and we view this as a financing tool actually. They want to sell their future production and get Bitcoin now. That's all enabled through the pool. So the miner comes, they're on our pool, they sell their forward hash rate, and then through the pool, we pay the buyer. And so for us, it's a tool that enables the derivatives world. And so, there's symbiotic relationships with ASIC brokerage and with firmware too. So yeah, so while it's not our primary revenue driver, it's definitely a key piece of our offering.
And how many VIPs are you guys able to take on these transactions?
Um, I'm probably not the right person to answer that question. Uh, You might have to get Guzman on to talk about that one.
Oh, sure, sure. And it might also be confidential. I don't know. It probably could be protected under NDA. So
It's different on a customer by customer basis. I think there's a baseline. To be honest, it's just not my area.
probably depends on volume, like how big the transaction is. Yeah.
Yeah.
I imagine it's not substantial, but as it grows, then the revenue grows along with it.
Yeah, exactly. And like to your point, I think depending on the size, there's different levers you can pull in terms of pricing.
Yeah.
Or what I think we as a company are getting better at is, if you're using derivatives and the pool and ASIC brokerage and firmware, like we can lower the cost of all of them as a package.
Yeah. Yeah. That makes sense. Okay. So you're covering three things there, the pool, the firmware, and the derivatives products. Are there any other products that you guys are excited about or perhaps have sort of soft launched or comfortable talking about at this point?
I mean, from a company perspective, we recently launched a logistics business, so I think that's an area of focus going forward. This is definitely not my area of expertise, but we've gotten involved in the ordinal world and the layer two development world too. And if you want to hear more about that, definitely invite Nick on here because he'll fill a half an hour, no problem. So that's interesting. And we do
Yeah.
have some pretty cool projects we're working on there. From the derivative side, we're launching the futures that we're super excited about that. And then we're keen to start looking at energy contracts too, I think down the road.
Oh, cool.
Yeah.
Let's hit on that a little bit. First, the futures. So you guys just got CFTC approval, sounds like,
Right. Yep,
and it's listed on Bitnomial.
that's correct.
Distinguish that from obviously that's sort of a kind of a market mechanism where it's less of a hedge and just more of an exposure opportunity. What kind of dynamics are people trying to get at when they're getting that hash rate futures?
Yeah, I would actually argue that it's still an effective hedge. Like, farmers use corn futures to hedge. Oil producers use, WTI produce or futures to hedge. So it's not necessarily that it's less effective as a hedge. It's just a different
Different
tool.
kind. Okay. Yeah.
Yeah, exactly. And like it very much mimics our forward contracts. The difference being it's a bit more standardized. It's on what's called, it's a lit market, so you can see price action in real time, whereas OTC is a bit more of like, higher latency call around type markets. And then I think one of the key differentiators of the futures, it's more institutional grade, more institutional friendly. So this is like a traditional finance construct where really the key value is it removes counterparty risk. So
Mm.
the trades are guaranteed. In the OTC world where our flagship products are, there's a lot of work that goes into managing counterparty risk. A lot of work. A lot of like credit profiling, a lot of like margin back and forth, a lot of
I
collateralization.
was gonna ask if there was more if collateral was required for
Oh yeah.
on okay, yeah, I would assume so.
Yeah, and then to make it even more complex, like you have to negotiate these terms on a person or an entity by entity basis. So if I'm onboarding you, for example, it's not going to be the same as I onboarded, the next person. So it's just
What's
a
your
lot of
can you have lower collateral if you have better credit or
for
what's
sure.
yeah.
Yeah, so like, I mean, going back to the pool analogy, so if we have a miner that wants to, use the physical forward and they've been on our pool for 2 years and they've bought firmware or ASICs and we have a relationship, they have a better credit profile.
Yeah.
If you're just somebody coming off the street and you haven't been on our pool at all, it's a lot riskier to us. So like we have to go through that kind of back and forth. Whereas on the future side, you basically just have to open an account with what's called an FCM, futures commission merchant, and you fund it. You could probably fund it with 25,000 or $50,000, and off you go. And that's easier. It's a bit more daunting for people that aren't familiar with it, but the barrier is much smaller.
When does this list?
We are targeting May 28th.
That is cool. That's the day of our Bitcoin Network Longevity Summit, uh,
That's right.
where we're actually going to be talking about core development and how we can fund future core development. So kind of an interesting coincidence there.
Yeah. There was a
Um,
lot of talk about core development. I did a panel at MIT recently, and that was a big focus there is the lack of attention to core development. It's a big problem.
yeah, well, help us spread the word. We're partnering with Core Scientific on that. Foundry is sponsoring, but definitely want Luxor there as the two kind of US pools. And then, of course, this isn't all in. This isn't everybody, right? We're Ant Pool's going to be there. I'm sure some of the other smaller East Asian pools will be there. Some of the other big ones over there, like Via BTC, F2 Pool. Is F2 Pool still associated with Bitmain or no?
I want to say yes, but not the expert. But by BTC, they're the one that won the Epics.
Yeah,
That
and
was
auctioned
a
it off.
that was a fun
Auctioned it
day.
off for a pretty good amount. I think it was over $1 million. I can't remember exactly. It was more than 1 million, less than five. I don't remember the exact number.
Well, they got that block too, which was like 36 Bitcoin, so they did okay.
They did okay. Yeah, I know. And that block was solved. I mean, I we'd have to probably get some like super technical guy in here to help us figure out like how the speed at which that block was solved was insane. And it's
It's
not like, I mean, people weren't able to just plug in that much more hash rate. Was it just luck, or what do you think?
I again, it's probably outside of my technical expertise. My assumption was people did plug in that much more hash rate just for a very short amount of time.
I tend to agree, but I'm like, can you plug in like, does that mean that there is, it's been an interesting study, but does that mean that there's like 30 or 40% more hash rate available to be plugged in? It's just in general not plugged in
I
because
mean,
of economics?
that's an interesting question because like I'm sure there's a that amount of S9s sitting around, but whether or not they're
But are
like
they in racks and
exactly right is the capacity there is another question.
yeah. I think that probably is the answer, but I was shocked at how much, and of course you don't see it really necessarily reflected in 2 week difficulty adjustment because of the
Right.
average, being averaged out. But in that short, 20-minute span, probably the block before and that block, you
It was
know,
quick.
quick. I mean, they probably solved 4 blocks in 20 minutes.
Well, they were
Slight exaggeration, but
definitely incentivized to do so.
okay. Well, so I think we've covered sort of y'all's roadmap, CFTC. Uh, what am I not asking that I think the audience would be interested in learning about y'all's forwards and the futures products?
Yeah, I guess there's a couple things we could touch on. One, so I mentioned the onboarding to futures is different than onboarding to forwards. So like if you wanted to trade at forwards, you'd basically call me or someone on my team. We'd send you the paperwork and we could kind of get you up and running ourselves. Futures is a bit different. Like we have to make an introduction to like an intermediary that will then fund your account and connect you to an exchange. So we realize in this space, the Bitcoin mining world, I wouldn't say like they're super sophisticated yet when it comes to derivatives. Like there's still a knowledge gap there. And so in order to help with that knowledge gap, we launched what's called an introducing brokerage business. And so basically the goal of that business is if you want to trade futures and you don't know how, that business line will help you get onboarded. So we'll make the introductions, we'll help you through the process, get you up to speed, and even give you the tools that you need to be able to effectively trade these. And so that's one thing. So we've launched that recently. That's another thing that we got CFTC approval for. And to be honest, like we're not doing that, and I mean this sincerely, we're not doing that to make a ton of money off of it, or our goal is for it to pay it for itself, but really to get people up to speed because we really feel like it's a gap in the space. And then beyond that, I mentioned energy contracts. So for the miners that want to trade energy futures, options or other products that they might be able to use to hedge their energy exposure, we're going to offer that too. And so like we'll connect you to different exchanges or OTC desks in order for you to like be able to manage your ERCOT exposure or whatever your energy exposure is. We want to be able to help with that too. And so that's something we're going to focus on later this year.
So help me, that's a little bit different than, purchasing a forward block of power, right?
It is
because when you do that, the collateral requirements are insane,
for
and
sure.
almost cost prohibitive. So is there more of a, I guess, a premium that a data center or a miner would have to pay to achieve one of those, hedging their exposure to like the real time price? I would imagine it would have to be.
Well, it's like it's a pro and con thing. I think the collateral requirements are much less. However, sourcing liquidity can be a challenge depending on what you're doing. Like if you're trying to hedge Henry Hub, it's not a problem. The liquidity is there in spades. If you're trying to hedge ERCOT or PGM or something like that, it's a lot more difficult because the markets are fragmented and like the futures contracts that are on like CME and ICE just aren't great. And so that's a problem like we're looking at to see if we can help solve. But that's a much bigger project than
You
what I'm
mean the
talking
markets just aren't deep enough?
They're not deep, they're not liquid enough. This
Not liquid enough. Okay.
yeah. And like I mean, you know how power markets work, right? They're very short dated, they're very fragmented. And so it's a problem. And for people that have like, variable PPAs, that can be a challenge to manage.
Well, I that's interesting. I would have assumed that with kind of the way, at least, ERCOT has traded, that there would be a little bit more liquidity there, just given the players involved.
Well, it's just I think the liquidity is there. It's just in fragments, right? It's not consolidated into a singular venue.
I
So
see. I see. Okay. I see.
yeah, so it's not like you can't do it. It's just, A, you have to have expertise. And B, like you're gonna have to have a team or a dedicated staff to like source that liquidity. And that might be a full-time job, right?
Yeah, I
Whereas
see.
if it was listed on a singular exchange like CME or ICE or Binomial, it'd be much easier because then you could just, consolidate the liquidity into one place. It'd be a much more effective hedging tool.
Yeah, yeah. I wonder how that could play in with the Infrastructure Act that the Texas legislature passed last year, incentivizing more firm generation, more combined cycle natural gas generation. I wonder if some of those companies that are looking at that, they're getting free financing to build it, you know, if they can find some, somebody on the other side of that trade.
Yeah.
I wonder if that helps provide them with some certainty.
I think so. I mean, in fact, we're very much in the research phase of this, and we're looking to seek friendlies that can kind of help us figure out what the problem is before trying to solve it. But I would agree with your statement. I think there's a way to make this win-win.
I'd probably want to introduce you to the guys over at Atlas Power. Um, they're, you know, pretty strong in the generation space. Um, and they know ERCOT well. They do combined cycle. I think everybody who does combined cycle or any kind of firm, hydrocarbon generation is looking at the Texas, um, this infrastructure bill, Senate Bill 6, Senate Bill 7, whichever number it was, that provides this financing. It's not, I would say it doesn't, it definitely changes all the incentives. And I think we will get more um, hydrocarbon-based generation, natural gas generation, but it's not such that people are rushing to do it.
Right.
So that probably means it was good policy that it's only changed the incentive structure slightly to where there were absolutely zero natural gas power plants planned in the queue, and now there will be a few.
Okay.
So that means perhaps it was good policy, although I'm generally against subsidies. But I guess the Texas legislature was having to counter the federal subsidies for wind and solar that created a lot of distortion in the ERCOT market, and I think probably in the CAISO market, maybe not so much in PJM or MISO, but definitely here in the South and the West.
Yeah, you definitely have to worry about how you structure your subsidies. You don't want to over incentivize.
Well, that's fascinating. Every time I hear about this, y'all are a step further ahead in what you're doing, and I think it's very important for the industry. Just to harken back to a point we made earlier, there will be more financing available for, you know, for miners that have hedged out exposure both on the power and the hash price side. So,
Yeah,
uh,
I would agree. And like I think a point of encouragement, at least from my eyes, is you are definitely seeing a shift, at least from the public miners that I talk to. They're hiring the expertise, they're exploring these products, they're onboarding, testing them out, to see if, I always advocate like at least onboard and test it out, even if it's at a very small, because then you have a tool if you need it, right? Like you can be opportunistic. It's not something you have to do actively if you don't want, but at least understand like what's available to you. And I think we're seeing a lot more of that recently.
it's fascinating stuff. Matt, where can people go to find out more about you and the work that you're doing? Is it Twitter? Is it a Medium, Substack?
Oh God, we are, as an operator of a trading desk, we're on Telegram, Discord, Slack, but I would say go to luxor.tech/derivatives to learn more. There's a multitude of ways to contact us. You can actually see, if you sign up, you can see our forward curve there. So you can see what prices are in October for hash price. I get asked that a lot, and we're like, no, we make it publicly available. Just sign
That's
up and you
cool.
can see it. And then if you're interested in the futures, we go live right around May 28th. It's not exactly final yet, but I think that's where we're going to target. And we'll be making an announcement on that shortly as well.
Love it. Love it. Thanks for coming to the show, Matt. And I'll see you here in a few weeks at Consensus.
Yeah, thanks as always. It's great to talk to you, Lee.